This is an Action Accounting News special report.
Good morning. Isabel Forstrom reporting on the aftermath of the collapse of Nortel Networks Corporation. With me today is Aaron Burke, a shareholder from the company. Joining us will be Marilyn Ontko, an expert on the Nortel situation, Matt Castle from the University of Calgary, who specializes in Symalacra Theory, and Nick Friesen from the University of Alberta, who's an expert on positive accounting theory. So tell me, Aaron, how has Nortel affected your life?
Well, Nortel destroyed my life. One moment my investments in the company are worth millions, and the next I'm out starving in the cold. As you know, Nortel joined the internet race, and for quite a while everything seemed perfect, and suddenly it all went bad. I don't know a whole lot about accounting, but after it all went down, there was a lot of talk about improper financial reporting, and you know what they say, cheaters never prosper. Caught up with them. I don't know how they could get away with it or why they would do it.
Let's go to Marilyn now and see if she can give us some insight on what happened.
Thank you, Isabel. Well, as you know, Nortel stock dropped about 33% after February 15th when CEO John Roth announced that they weren't going to make their expectations. This came as a huge shock because just 6 months before this, their stock had made up 37% of the TSE's composite index. But it shouldn't come as that big of a surprise because the demand for internet supplies was decreasing and Nortel's stock kept increasing. In fact, it increased ninefold over a period where they reported loss after loss. Their losses actually reached the multi-billion-dollar stage in some periods.
So if Nortel was performing so poorly, why was there such high speculation on their stock price?
Back in 1997, when John Roth took over as CEO, Nortel found that they were far behind in the internet industry. They'd been using an alternate protocol while the public had started using the IP protocol. They decided that they too want to use this protocol, but they lacked the knowledge. So they decided to start acquiring companies, and in a short period of time, they acquired $30 billion worth of these companies. They didn't want to account for these in their financial statements, and in the US, lots of the other companies in their industry weren't accounting for these acquisition costs because of a loophole that the Americans had where if you met 12 criteria, you didn't have to account for goodwill. So Nortel started to put up two sets of financial statements, ones that were made according to GAAP and other ones which were comparable to these other companies. Although Nortel originally called this other set of reports supplementary, in 1999 they changed it to be called income from operations, which made them look more reliable.
But why did analysts continue to tell the public to buy the stock when, in reality, they had losses period after period?
Analysts believed in these pro forma reports. They allowed them to compare Nortel to the other companies in their industry. If you remember back to October of last year, the Nortel missed its earnings projections by 1 cent, and there was a huge decline in stock price. Now this was an overreaction to the market, because after all, they'd only missed it by 1 cent. However, it was probably just the market reacting to the realization that the shares had been diluted, because most of the $30 billion acquisitions had been purchased using treasury stock, and the market had never adjusted to this.
Thank you, Marilyn. We now move to Nick Friesen, our local positive accounting theory expert.
Thank you, Isabel. I'll take you through the basics of positive accounting theory, or PAT, as us in the business call it. PAT is an expression of neoclassical economic theory and believes that material self-interest drives economic decision-making. Since all actors are self-interested, contracts become necessary to have different parties collaborate with one another.
Yes, and Nortel?
Let's consider shareholder interest first. During the late 90s, the telecommunication industry was rapidly growing, and Nortel's share price was increasing, and the stock was becoming widely traded. This increased the amount of transient shareholders, or short-term shareholders. These short-term shareholders were more concerned with short-term gains than long-term performance. They would have put pressure on and offered incentives to management in order to acknowledge short-term gains, even if it was detrimental to the long-term performance of Nortel. Also, let's consider executive compensation at Nortel. The executive compensation largely consisted of stock options. Stock options are often seen as a great way to align shareholder and management interests. However, these stock options were given at a time when the stock price was already overstated. the stock price was no longer an effective measure at evaluating management, and the stock options did not align interests. Also, let's consider how the amount of analyst expectations placed on the company dramatically increased up to the millennium. Management was being evaluated on these expectations, and thus they were following their own interests in disclosing information in such a way that it satisfied meeting these expectations instead of disclosing accurate information to shareholders. When you consider all these factors, it's no wonder that Nortel made moves to acknowledge short-term, insubstantial gains and information instead of planning out the long-term performance of the company.
Wake up!
Thank you, Nick, for that very interesting point of view. We now move to Matt, who will talk about Symalacra Theory.
Hello, my name is Dr. Castle. I am the local expert on Symalacra Theory. So before we take a look at Nortel and how Symalacra Theory affects it, let's first take a look at Symalacra Theory as a whole. Well, Symalacra Theory was developed by a French philosopher by the name of Jean Baudrillard. It was an extension of existing semiotic theories. However, Baudrillard took it a step further. His theory looked at signs and images and how they convey reality in our everyday world. According to Baudrillard, there are 4 phases of the sign-referent relationship. The sign is either a reflection of basic reality. The sign either can mask and pervert basic reality. The sign masks the absence of basic reality. Or the sign bears no relationship to any reality at all. This is known as a pure simulacrum. It is the 4th phase of the sign that we are interested when looking at Nortel. In the case of Nortel, it would appear that the numbers they were reporting were signs that bore no relation to reality. In fact, in certain cases, the signs even preceded reality, and in doing so were able to create a reality of their own. An example of this is Nortel's uncanny ability to meet its earnings projections. In fact, it even exceeded its projections quite often. Nortel would give analysts a predictions number, and in this case, the earnings predictions were the sign, and the sign created another sign that allowed them to meet these outrageous expectations. By referring one sign to another sign, Nortel was able to successfully simulate a reality. Nortel's simulated reality was much more inviting than the alternative reality. The alternative reality was shown on the GAAP balance sheets. Well, we can't say that this is reality, for it has many signs in it too. It was another simulation of reality. However, Nortel's reality, in the form of net earnings from operations, was able to meet and exceed shareholders' expectations quite often. The simulated reality in the form of net earnings from operations therefore became a more tangible reality to shareholders than was the GAAP reality. So in the end, shareholders began to believe the simulation more than they actually believed the GAAP reality. But unfortunately for Nortel, the simulation ended up outpacing itself. It could not keep up with its own expectations. Once the simulation could no longer support itself, the public was open to the reality of Nortel, and it was a flop.
So you see, Aaron, according to positive accounting theory, your interests were aligned, and they were just doing what was best for you.
Best for me? Excuse me, this is best for me? Losing all of my money? Okay, maybe they were acting in their own self-interest, but not everyone's self-interested, or I wouldn't be eating. And rational actor? Sure, I may be an actor, but do I look rational? No.
Well, then obviously Symalacra Theory must explain it. The numbers they gave you just weren't real. They didn't even exist at all.
He has an incredibly over-cynical view of the world thanks to his little theory. And what does Symalacra have to do with actual accounting procedures? If the numbers didn't exist, why were they there?
Okay, well, this has been Isabel Forstrom, Special report for Action Accounting News.